Good evening, everyone. Welcome. Thank you for being here. We appreciate it. Before we get started, please read the disclaimer. We are not financial advisors. We have no idea what your situation is. Please take everything we say with a grain of salt and always do your own due diligence. Tevis, Roy, how are you?
Doing good. Another fine day to talk the markets. Never a dull moment. How are you, Steve?
You know, I'm feeling left out, but it's okay.
Well, we are then, you're certainly not going to be left out of this. This is a very Steve topic. It's an all of us topic as well. You posted and did a video as well, which I've not watched, full disclaimer, yet. Just limited on time right now. On Amazon specifically, Walmart, a lot of the rotation that's happened towards value, or at least perceived value. And so, Steve, if you want to, that's our topic tonight, guys. Thank you guys for joining us. Steve, if you want to kind of kick us off, and then Tevis and I will jump in as well.
Yeah, so I'll give you guys just the broad strokes of what I had said and what I was thinking. And it's funny because I've been talking to a few people and there's a new thesis forming that makes a lot of sense. So I've been battling this for a while, and I was saying that it doesn't make sense that Walmart and Costco trade the valuations. And everybody's been saying it's a flight to safety, flight to safety. And I'm calling BS on it. So Amazon crossed over. They're doing the most revenue out of Walmart, Costco, and Amazon. And then my argument has been if Walmart and Costco are getting a multiple because their revenue is considered sticky and people aren't going to stop buying groceries and durable goods, Amazon should get the same multiple. And when you look at it on a yearly basis, there wasn't a single year in the past decade where Costco or Walmart increased their revenue on a year-over-year basis more than Amazon. And from 2016 to the trailing 12, Amazon grew their revenue by 427%, Costco 137%, Walmart 44%. Going forward, 26 through 28, Amazon's expected to add 293 billion of revenue, which is more than the combination of Walmart and Costco. And it just continues to be disproven, this whole logic. And then when we look at growth rates, Amazon has grown their revenue at a higher growth rate, except for 1 year, Costco overtook them. But going forward from 26 to 28, Amazon is growing at an average annual rate of 12.1%, whereas Costco's at 7.72, Walmart's at 5.44. So the reality is Amazon should be getting a bid, because if we're going to say a flight to safety and anti-tech trade, Amazon's revenue is more sticky than these two. And when you look in, I haven't updated this in a couple of days, but it's roughly the same numbers. Amazon is trading at such a compressed multiple compared to Walmart and Costco that it just does not make sense. And on a forward earnings basis, you're paying 41 times Costco 2028 earnings, 36 times Walmart, and then under 17 for Amazon. And Amazon has double the EPS growth. So it just annoys the hell out of me that there's this whole narrative in the market that, flight to safety, sticky revenue, blah, blah, blah. Yet when you actually break the numbers down on growth rates and how much they're adding per year, neither Walmart or Costco holds a candle to Amazon. And Amazon should get a bid because they have two big things that they don't have. Stripping away the logistical network, they have AWS, which neither of them have, and they have an ads business that just did 21.3 billion in Q4 and is approaching a run rate of 100 billion revenue annualized, which neither of those platforms have. So the whole idea is just bullshit.
Yeah. Tevis, what are your thoughts on that specifically, being that it's just flight to safety stuff? Why is Amazon not being considered in that case? Or is there something else going on in your mind that's leading it to give underwhelming returns?
Yeah, I just don't think the market sees Amazon as a flight to safety right now because of the capex spend, and they're bucketing it more in the sort of AI trade, and the AI trade is more uncertain as to what that's going to materialize back to actual revenue and profitability. And like we're highly confident because we know that they're going to execute well and it's going to yield some returns, but the market doesn't want to take that chance. I think it's actually super overblown, the rotation, because now you have some value stocks trading at like way higher multiples than the Magnificent Seven, essentially. But hey, man, that's the market. That's the opportunity that you are provided from the market.
Yeah, I think that you're right. Like at least that's the hangover on Amazon. Like it doesn't really explain the big rotation beyond the names that you mentioned, Steve. Like there are names that are cheaper in that kind of safe anti AI space, but there's a lot that are not. You know, Caterpillar, John Deere, for instance, Target is still relatively cheap, but you look at where it's climbed over the last 3 months, it's gone up in a hurry. And there's a lot of these, like Crocs is another example that's, they reported, I think, negative, just slightly negative revenue growth. And that's a trend of a lot of these. Very minimal revenue growth, if not negative. Very minimal EPS growth, if not negative. But I think the market right now is just so spooked by AI that it's like, okay, what are the companies that are not going to be disrupted at all for sure? And we're going to buy those no matter the cost, which honestly I think is really, really silly. But that's kind of where we're at right now. And so, like, that's a hangover, even if it wasn't for the capex stuff with Amazon having to do the equity raise. But regardless, I think that we might be in this for a little while longer. Do you think there's any merit to like the flight to safety? Is there something more coming? Was it possibly trying to front run the tariffs being repealed? Because for a lot of these, it's actually a really bullish thing, depending on how that actually shook out with the Supreme Court. Or if not, when do you think that perhaps the market realizes, oh, buying some company that's barely growing at a 43x price to earnings is maybe not the best choice?
No, I think Tevis is right. I mean, a lot of people are questioning the amount of capex that's going to be deployed this year. And the reality is they have no right to question it. They have no right to go against these CEOs. They have not built these companies. This is not one company that is going off the reservation. And when you look at the data over the past 5 years, these companies, it's not just Amazon, it's Microsoft, it's Alphabet, it's Meta. You don't grow your cash from operations or your EBITDA, whatever profitability metrics you want to look at, without investing in yourself. And these are the companies that have grown the most on a dollar basis. These are the most profitable companies in the market. And when you look at Amazon's playbook, they have never cared about buybacks and never cared about dividends. They have always thrown the money back into the company. And it has allowed them to build the most incredible logistical network behind the DoD. It has allowed them to build the largest cloud service provider. These companies are dictating the future. There's no companies that can compete with them. The reality is these four are going to spend 620 this year. And if this growth rate is even a fraction of what it is next year, they'll exceed 700 billion. Show me companies that can actually compete with these four from a cash deployment. There's no way. So I think the market, or let's say a lot of investors and analysts, are getting it wrong, and it's causing an algo trade to the downside because they can't wrap their head around how big these numbers are, but they don't actually understand that these CEOs understand the businesses better than the people on the sidelines, better than me, better than the two of you, better than any of these analysts. And these CEOs and management teams are saying, this is what we need to do to compete in the future. This is where all the profitability expansion is going to come from. And this is what we need to do. And for people to be up in arms about it that don't have insights into the business and just think it's a ridiculous number, who are they to say it's a ridiculous number? You have the CEO of AWS coming out saying they're going to be compute constraint for the next several years. That's what's spending $200 billion on capex. Now, part of that is going to be for logistical, sure, but these companies have huge backlogs. So unless we're going to say the backlogs are not real, which you can't do that because we see the documented revenue that auditing firms have cleared. So how are we going to even say that this is ridiculous? I think the whole trade to the downside of the mag or spectacular six is ridiculous. I think they're trading at depressed valuations for no reason. And I think the market is backwards right now. Companies like Deere, great company. Companies like Walmart, companies like Costco, they should not get bigger valuations than Microsoft, Alphabet, or Amazon, or Meta. It's just, it doesn't make sense.
Yeah, that's. I think that's more than fair, and that's similar to my take too. So before I ask Tevis, when do you think that the market kind of wakes up and says, okay, maybe buying these companies that are not really growing at 40x is not the best thing? Do you think it's going to be like maybe next earnings season? Might it be all year? I mean, nobody knows, but what would you say, Steve?
I don't know. I think we need to see a couple. I hate saying we need to see a couple of quarters, but at this point, I think we need to see at least 1 or 2 quarters of continued expansion, and then we need NVIDIA to blow the doors off next quarter. You know, I do think there's a world where if Jensen comes out and generates a drop the mic moment again on Q4 earnings and guides for more revenue and more profitability than people thought for 2026, that this whole AI is a bubble story and the fears around capex being deployed, maybe they dissipate a little bit. I think a lot depends next week on Jensen.
Yeah, I would love for you to be right on that. I think that there's 0% chance of that happening. Jensen already made it very clear, like, this is not a bubble. TSMC like really led the way with this earnings season, like saying this is not a bubble. Every single other company has echoed that. Jensen has along the way. Of course, it's not been earnings. And even if they have ridiculous revenue, ridiculous guidance, everything looks amazing for NVIDIA, the market, at least it's in the mood to right now, just be like, oh, well, that means a lot of capex, so that's bad, which is just silly. It's short-sighted. But the thing is, the market can be irrational for much longer than we would expect. So, Tevis, I guess for you as well, like, is there any merit to this rotation to at least perceived value and away from things that could be disrupted by AI? And when do you think that the market kind of wakes up and says, okay, it's a little bit too much and starts shifting in other sectors?
I think the market is going to start to realize it until some of the ROI starts coming through for the Magnificent Seven. So I think Steve might be right in a couple of quarters, but essentially when we're seeing that there is an acceleration in the growth or a reacceleration as a result of the capex spending, and we're seeing that it's here to stay and that it's actually going to be as big as, you know, these companies are making it out to be, then I think that's the next leg that's going to sustain it. But until then, the market's sort of calling BS, and it's just, you know, prove it phase. And so until they prove it, I think they're going to be unloved a little bit. Yeah, I'm sure NVIDIA, you know, crushing earnings is going to help, but at the same time, like, all of these companies are spending capex, and then it becomes a question on a company by company basis, which ones have the execution in order to see that capex materialize into revenue in a sustainable way, and to what degree. And I think that's there's going to be some that are wastefully spending on capex, and they're going to capture some yield, let's say, but not as much as they could. And there's going to be others that are really accelerating as a result of their spend. I think, honestly, man, Apple might be a good case study here, because Apple is not spending anything on capex, right? And so what I would imagine is, in one way or another, you're going to start to see a divergence in Apple versus the rest of the mags, because either they're wastefully spending and Apple's comes out like the smartest one on the block because they're not, and they had the best AI strategy of all, which is to do nothing. Or you're going to see these other ones that are like, the more you spend, the faster that they're going to grow, and Apple is actually going to fall behind even further as a result. And I think you're going to start to see that divergence within the next 2 to 3 quarters.
I like that take quite a bit, Tevis. For Apple itself, one thing that I've seen a little bit of, more so a couple of weeks ago, but at the start of this year, has been a little bit of revisionism as it comes to Apple. That there's people that are very bullish Apple, love the company, love the stock, and you do you, that's fine. But they almost want to say, oh, Apple was right all along. But if you look at what they were trying to do in 2023, 2024 as well, it's not that they were right. It's that they failed so spectacularly multiple times that they're just like, okay, we're actually terrible at this. We're not going to even try anymore with the AI stuff. We can't do it. Or at least they couldn't do it easily with what they had in-house. They would have had to do some sort of acquisition like we talked about previously, them acquiring Anthropic, which would have been like insanely accretive if they did that, but instead they just punted. So on Apple specifically, Steve, do you think that Apple is going to be rewarded long-term for the strategy of just punting on AI? Or like right now it's actually basically flat year to date? Or do you think that might actually increase the spread and the differential between the rest of the Mag 7 and them?
I think there's a big misunderstanding when it comes to Apple, because I've heard that take trying to be made a lot. And you have to actually go under the hood and look at Apple's past 3 or 4 years of growth on EBITDA or cash from operations compared to the rest. The big reason why they haven't had a huge capex allocation, they don't run a cloud service business. The only thing they do is provide an additional upcharge for additional storage for iCloud. They're not running a corporate and infrastructure cloud business the way AWS, Azure, or Google Cloud is. So they haven't had the need. Now for AI, they made a decision that they're just basically going to piggyback off of whoever's the winner, and they'll pay them $10 or $20 billion a year, embed into their products, whatever it is, which is fine. That's always been kind of Apple's MO. They're never first, but they're usually the best or one of the best. Now, when you actually look at how the capex allocation has supercharged a Microsoft or a Alphabet with the growth, I mean, when you look at Apple, the reality is that their EBITDA, we're just going off of that, over the past 4 years has gone from 130 billion to 152 billion. That's not a huge increase by any means. But you look at Microsoft, and Microsoft's EBITDA has gone from, over the same period, 98 billion to 175 billion. It is a drastic difference. And it's the same differential with Alphabet, Amazon, and Meta. There's a clear correlation to these companies investing in themselves and completely boosting their profitability than Apple's take, which is growing on just units being sold. They're not really innovating over the past 3 years. It's just services, which is an add-on feature, and units being sold. So I think it's a fair take to talk about, but I think that the data is very clear that Apple is not growing their profitability at anywhere close of a range compared to their competitors. And I just don't think it's ever their MO. So,
yeah, we'll have to see how that plays out. We do still have that bet. That's a 5-year thing. Not looking good for me so far, but it's anyone's game at this point between you and I. Just a small gentleman's bet for a charity of our choice. I'm betting that the S&P 500 outperforms Apple. You took the other side. Any change since we made that bet in your perception of Apple? Like, are you like, hey, no, I'm still solid? Because I mean, right now, if the bet ended right now, you would be in the lead by a decent bit. So,
yeah, I mean, look, Apple's a great company. I think that they'll outperform the market. I just don't think that they're going to be some super winner. To outperform the market, if Apple doesn't do well, it's hard to see the market really doing well. It's just one of the core components because Apple is also an indicator of the economy to some extent. So for the market to do well, we really need to see Apple doing well. And I think the data is pretty hard to get past. And I'm not saying that Apple's going to be the winner in the Spectacular Six because I think they're probably going to be the last place in the Spectacular Six. I just think that they're going to outperform the market because ultimately I think the market is going to be significantly higher 5 years from now.
Yeah, and you could well be right, but I agree with you. It's the weak man. Other than like Tesla's kind of the weird one, right?
That's why I'm saying Spectacular Six.
Yeah. All right. So any more? I guess on Amazon, in its current range, are you guys? I don't have a position. You both are shareholders. Are you just DCAing? Are you waiting like for certain levels to dramatically increase your position? Are you waiting for more information? Where are you at with your positions on that?
Yeah, I mean, I haven't bought, but in the past 2 weeks, but I am going to buy more. I think it's so undervalued that I want more Amazon in my portfolio.
What about you, Tevis?
You guys keep asking me every week, and every week's answer is the same. I have no money, man. Like I don't, like I would be a buyer here. What's that?
Even billionaires run out.
Yeah, I mean, I've run out long ago. I'm like, I would be a buyer here, but
yeah. My cash is wiped out after today's purchase, so I have like I think $1,000 in cash left that's in my portfolio, maybe a little bit more, but it's like, yeah, it's nothing. So I have to get creative. If I'm buying something, that means I'm probably trimming for something else, and it would only be, I don't know. It's tough. Like this is the opposite of what we had 6 months ago, where it was hard to find deals at the time. You had to really search, and now it's like, man, it's hard to not find deals. We don't know how long this is going to last. For some perspective, for some of those that might be a little bit newer investors, we go through this sort of thing. Like it always looks a little bit different, but with growth, specifically in tech, every few years. And the last was in 2022, that there was a lot of people out there claiming that, it was the time for a value to like just dominate over the next decade, that tech was just kind of a thing of the past, and growth, as well. Growth never goes out of style for long, honestly. And tech, especially when it's disruptive tech, really doesn't go out of style at all. Now, we could see the market remain irrational for a long time. We could see Amazon fall a lot more. We could see Walmart trading like 60 times price to earnings or something like that. And Caterpillar, go up another 50% or, who knows? I'm personally not going to chase that. I'd rather use this opportunity, even though I'm pretty much out of cash. I do have money coming in most weeks, several times a month at least, and I'll just deploy that. I'll use premiums off of selling options. I'll occasionally take some winners and put them into some others. And on that note, I wanted us to maybe pivot, unless you guys have anything.
Real quick, before we pivot, just look at how cheap these companies have become. I mean, this is getting insane. I'm doing Costco right now, so just give me a sec. I have not, except for this run, maybe 2022 is the last time that I have seen these companies this cheap. To think that Meta, Nvidia, Amazon, and Microsoft all trade under 20 times forward earnings. And Alphabet, after the run it's on, is at 20 times forward. It's insane. These numbers don't make sense. And they certainly don't make sense when you look at why did this screw up here? Hold on.
Yeah, if that was
certainly
Walmart.
don't make sense when you look at Walmart and Costco. I mean, how can you say, okay, this year earnings, both Walmart and Costco trade over 40 times, yet Alphabet through Meta are all in the 20 times range. And then you go to 2028, there needs to be a very strong pivot, especially when you look at the percentage of EPS growth that these companies have. It just doesn't make sense. Amazon and Nvidia have such huge EPS growth over the next 2 years from when this year closes through 27 and 28, the numbers don't make sense to me.
Yeah. So Sauceman 2025 asked at 9:25, would it be wise to just allocate all the remaining money into Meta, Nvidia, Amazon, and Microsoft? Of course, not financial advice, but all those I think are great companies that are going to be better as a company, as a business, and probably higher in the long term. The market can remain irrational for a while. So, it depends, of course, on your goals and everything. But yeah, it doesn't feel like a scary thing at all. And usually when there's a shift as far as like sector rotation, then things can go up violently. I just don't know when that is. Tevis, do you have anything else to add before we pivot and talk about some gainers and losers?
No, we can move on.
Okay, throw this up, Steve. This is S&P 500 component year-to-date returns. What I wanted to ask you guys is, okay, so there's some like ridiculous gainers. SanDisk goes up like 10% every week minimum. A lot of interesting mix here. So you have, of course, some that are very much tied to the AI trade. Teradyne also in that as well. Some big reversals for Generac and Moderna, which were bottom feeders last year and big winners this year. You, of course, have some of the flight to safety, flight to value in Deere and Company as well. And so at the very bottom, you likewise have, it's a lot of names that are in the sectors that we talk about quite a bit, which is software is getting absolutely killed. Anything to do with crypto. The trade desk kind of has its own issue. I'm not really sure why AppLovin is down that low, but yeah, definitely a lot of SaaS names, which you'd usually expect to see at the top of the list. So my question is, and I can go first and give you guys time to think on this, but if you had to pick something that has gone up or down, I want you to pick one name that has gone up 25% or more. This is just hypothetical. You don't have to do this. That you think, hey, this is going to probably continue to run through this year. And also one name that is down 25% or more, which there's fewer names, and that you think is an excellent candidate to be a reversal this year, not talking about long term. So with that in mind, what my mind would be, I'm very tempted to say Teradyne, just because I know what's happening in that space, but I would actually pick Micron. There it is, number 9. It's up 50%. The craziest thing about Micron, it's a triopoly essentially, and the demand for the DRAM, especially at this time, is ridiculous. So I think everything in that space is going to benefit. And looking at Micron, their forward price to earnings next year is like 12. Their PEG ratio is, I believe, 0.1. Double check me on that. It's ridiculous. Now, if you don't believe in the growth, if you don't think it's going to come, if you think it's going to fall off the cliff, this wouldn't work. But we're not going to see that this year. So I'm not doing this, but yeah, I think that it might run quite a bit. And for the rebound play for myself, I've had a little bit more time to think about this just because it was my question. I would love to have extended it to 20% because I picked Palantir to rebound. But instead, I would actually pick AppLovin. AppLovin is down about 38%. You look at the growth. I'm not really sure why the perception is there necessarily. We're in a midterm election cycle. I know the trade desk is also in the same space as far as advertising, but there's still hyper growth. I think that they're undervalued right now. And the product that they've actually built as far as advertising, it's not being disrupted at all. In fact, I think it's becoming more valuable because you can verify that human eyeballs are actually seeing those ads versus a lot of other companies. It's getting harder and harder to do that with. So my pick for the rebound this year would be AppLovin. My pick for a continued runner would be Micron. What about for you guys? And I guess I can bring up the list again. I'm sorry. I shouldn't have.
One, you go first.
Yeah. You want to go, Steve? Okay.
Tevis, if you want me to go, I can, but you can go first.
Let's do Tevis.
Sure. Yeah. I'm just looking at the list here. I think for the 25% up to continue going up, I like Micron a lot, actually. I think. Sorry, I'm just reading the list.
There's a lot of good choices.
Yeah, Micron's a good one, I think. Teradyne, I was was thinking also like Applied Materials, maybe. And then for the negative 25%, I think Robinhood's an easy pick there. Robinhood's down 32%. There's nothing really wrong with the company fundamentally. I think they'll be fine. I think Adobe is definitely not going to be fine. Down 26%. I think they're going to continue to be down, especially with the news that came out that Google just released this week. I don't know if you guys saw that. That's wild for Adobe's business. But yeah, I would say those would be my picks. Go ahead, Steve.
What did they announce?
Let me find it. You go
'Cause
ahead.
I just pulled some news that Anthropic announced that shook CrowdStrike, which is crazy.
Yeah, I love that. Like CrowdStrike is not negative 25% or lower. Otherwise, probably that would be my pick. Although, like, it could be hung over for a little while as far as the downside. But I've wanted to get in cybersecurity at some point, and I've missed it before. I missed it, the silly overreaction of the CrowdStrike issues a year and a half, 2 years ago. Man, if the market somehow thinks that AI is making these premier cybersecurity companies less valuable, that's a wild, crazy take. No matter what Anthropic launches, maybe it's another competitor that's in the space. But man, I would love that thing to get silly as far as valuation.
Yeah, the reality.
Throw this up, Steve. Google Labs, February 19th. Today, we're introducing new feature, photo shoot. With photo shoot, you can start from a single image of your product and easily create high quality, customized product shoots to elevate your marketing. So you basically upload just the product image there, and then it just immediately gives you all kinds of different marketing materials. So graphic designers, marketing folks, basically screwed, for lack of a better term. But think of what this can do for like all the ads, all marketing content, social media content, so on and so forth. It's just instantaneous now. So, I think more tools are going to come out like that. Photographers are going to be at risk, marketers at risk, brand agencies at risk. Obviously, from a platform perspective, Adobe is going to be more and more at risk because you're getting into this place. Like I saw the other thing where they were making trailers almost instantaneously for brand like brand portfolios, brand packages, and I think it's just going to continue down that. Like, if I was at Adobe, my days would be numbered. It is my thought right now with everything that I'm seeing with AI. And it's not just like the innovations are happening at an equal pace across different verticals. Just as impressive as Claude Code is from the software development perspective, there is an AI tool that's equally as impressive for graphic design, that's equally as impressive for making a movie trailer with Cdance and so on and so forth. And they're all moving at a rapid clip across different verticals. So there's going to be displacement for sure. And I think Adobe is one of those tools where like they have a monopoly or they have a moat essentially, and the people who use it freaking hate using it. So so I do think there's something there.
So what about Figma? Do you think this is really bearish for Figma as well?
No, because Figma is actually partnering with Claude to make the process easier. And I think Figma is like fully embracing. Figma's always been more collaborative in terms of its nature. Like Figma, I can work on Figma with 12 other designers, and we can all collaborate in a shared environment, essentially, like similar to how you would work on a Google Doc or a Google Sheets or something like this. Whereas with Adobe, it's always like, hey, I'll give the file to someone, they'll work on it, and then they'll export the file to something else. So I think Figma is fully leaning in, and I think they're going to be a beneficiary, because if that step of the design process will exist in the future, and we can talk about that, I think it will. It's going to look different, but it will. Then people are going to need a place to do that work. And I think that's going to be increasingly Figma and less so Adobe in the future.
This is why Adobe has been the company that I've been unsure about when I've said that I think the downturn in SaaS is overdone. And I've repeatedly said, I don't understand Adobe's business model enough to say that I think it's going to be okay when I see what AI can do for at least smaller or independent individuals or firms. I don't know that they need to pay $20 a month for the Premiere package or whatever it is. Like, sure, you're probably going to need the Adobe products if you're editing movies or that type of stuff. But for the normal user, I think the AI tools are going to severely impact them. And I would say Adobe's the biggest loser in SaaS, just from the idea of how much do you really need to use Adobe for editing now with all these tools that are being launched, or what you can build just by doing prompts. Now, from Roy's list, I'm actually a shareholder in Corning, and I would say Corning's still going to go higher. Since I'm a shareholder, I'm going to take Corning, although Micron looks still incredible. And the reversal would be Salesforce, because I still think that when they report next week, Benioff's going to come out, great quarter, great year, increased guidance, huge cash flow machine, and AI is not replacing Salesforce. It could replace Adobe, but enterprise software platforms such as Salesforce and ServiceNow are likely going to be fine.
Yeah, let me give you a slightly different take on that, Steve. So I think we've discussed the death of SaaS at length at this point. I think the more and more that I think about it, man, it's not so much the like instant death of SaaS that I fear, that there's going to be a disruptor that completely negates their business. But I think that their revenue and pricing models have to change fundamentally for them to survive.
Absolutely. And I can bet what you're going to say. That it's going to change from a per seat model to what they can monetize with agents.
Well, sure, but more so on the first part, right? I think the per seat model is going to get displaced because I next year will need fewer seats than I need this year. Not necessarily because I'm firing people, but the people that I have are way more efficient because they're empowered by agents. I think that one interesting model that I've seen being floated around by smaller startups is humans pay less, agents pay more. I don't know if you guys have seen this, but I've seen several tools out there where it's like, hey, if you're human, it's $5 a month. If you're agent, it's 50 a month, something like that. How do you determine if it's an agent? Well, okay, are they operating on the interface, or are they making just API calls? I'm sure it's going to get way more difficult to detect in the future, but like that's an interesting adjustment in pricing model. But fundamentally, like if I'm using Adobe and I still need a graphic designer and I currently have 3, well, it's like, cool, whoever's my best graphic designer is staying. And now I'm going to have 3 or 4 or 5 agents that they're working with, and my output will still double or triple. Meanwhile, my headcount will, go down by 60%, and my costs will also go down by that much. But if you're Adobe, all of a sudden you're getting paid for 1 license as opposed to 3 in this example.
Which is why Adobe's been the one that scares the hell out of me, out of the big ones that have fallen.
The seat-based pricing for sure is something that I think is going to be a challenge for a lot of SaaS. But there is a lot of SaaS also that really doesn't do much seat-based pricing, or they just fully do usage-based. And yeah, there's the market right now is kind of in a shoot first and ask questions later. And not all SaaS are created equal. Not all SaaS are being disrupted. I think that we kind of agree that it's not sure and certain, but Adobe sure feels pretty weak right here, despite the valuation, just from what's happening in the space. But yeah, there's plenty of others that, like Intuit. Intuit was one of those biggest losers there, down. Actually, the biggest loser in the S&P 500, down 42.5%. Now, there might be some other reasons why. It's not a company that I keep track of like avidly, but is AI just going to immediately replace a lot of the business logic? Is it going to replace, like, for instance, being able to file your taxes? maybe eventually, but boy, I think it's just a long ways away. Same with Workday. I don't see them being disrupted anytime soon rapidly, but they have traded at a premium. SaaS traditionally has. It's just no longer the case right now for a lot of these names.
Yeah, I mean, when you talk about a company like Workday, take the stock price out of it, just the fundamental business case for Workday, companies aren't getting rid of it. And I'm just making a general statement. That's going to include Oracle, that's going to include SAP. You have to have, if you're a large business or a medium-sized business, an enterprise resource planning platform. Now, they may decide to go from one for another, which is still unlikely because the uplift on implementation, the RFP, C-suite staking their career on making a wrong decision. There's a lot that goes into it, but I don't see Anthropic or a company, even if they came out with something, which I don't think they're going to, I don't see companies staking their future going with, oh, let's get rid of Workday and move all of our HR, all of our payroll processing, all of our accounts payable, all of our accounts receivable, everything that we do from learning and talent to everything else onto some new AI platform. It's just, I've been through the implementations, I've led the implementations, I've done the RFPs. These decisions are not taken lightly. Every company has a back-end system, whether they are piecing together ADP for their HRIS, getting Sage and smaller companies for the finance side, or moving to an ERP system. Paycom is another player in the HRIS that do strictly HR. Companies need this for back end. So I think that these are fine.
It's not like, okay, what would you call a displacement of Workday? Let's say it's either, let's say they lose 20% of revenue. Yeah. Would you consider that to be like catastrophic case for Workday?
That would be horrible for Workday, but they're not going away.
Yeah. Just hold on. So like, sure, they're not going to go to zero. I mean, maybe.
And it's not just Workday in general. I'm making a generalization with those types of platforms. Like the question is AI going to replace those platforms? Like they can give and take between each other, but is that segment Microsoft Dynamics, SAP, Workday, and Oracle PeopleSoft are the big four?
Yeah.
Are those going to get displaced, replaced by AI? My answer is no.
Sure. Let's just say for a second, like let's take Workday just as an example. We could take Salesforce, we could take Adobe. It doesn't really matter. Let's just take one of them. In my mind, it's like, okay, they lose 20% of revenue. Either they lose 20% of their customers, or they keep all of their customers and all their customers pay them 20% less, right? And if you all of a sudden have AI enablement that can lead to you needing fewer licenses for your organization. Let's say I have 5 licenses in 2026, and as a result of AI, I can build a dashboard to, somebody's on the read only, they're not on read write, whatever. I remove 1 license. If everybody goes and does that, Workday is down 20% next year. And what that does is it doesn't take Workday to zero, but it buys another year for AI to just get better and better. And maybe in 2027, I don't need 4 people anymore. I need 3 licenses. And maybe in 2028, I need 2 licenses. And maybe in 2029, I only need 1 license for Workday. And so all of a sudden, you're elongating that time, but it's a slow march to the death. It's not like immediate, like, oh, Workday is displaced. Everybody go home, stock goes to zero. It's just they're going to stop growing and they're going to plateau and they're going to slowly lose out revenue as a result of the efficiency gains that AI tools built on top of Workday will allow for.
So I'm going to make a generalization. There's probably things I can't say, but in general, the way the contracts of these scales work are on a 5-year rate, and then normal renewals are on a 2 to 3 year basis. Now, there's always a true up period, and these types of contracts are by headcount. So the big disruptor, as you said, could be that AI gets so efficient where we see a lot of back office services contract, and on a renewal, there'll be less licenses. And that could definitely happen where The company may not get rid of a Workday or an Oracle PeopleSoft, but instead of having 8,000 headcount, they may have 7,500 or 7,000. And that may not be enough to offset the annualized increases that they were able to charge for that product. And that could definitely stall out growth. There's no question that that can happen. So absolutely that can happen. And then it becomes, can these companies generate enough profitability to financially engineer earnings the way Apple has, which is buybacks, to get accretive EPS growth? Because that becomes the only way that these companies can grow, other than charging more on a per head count.
Well, not necessarily, right? Because let's say Workday or Salesforce or any of these SaaS tools can adopt their own AI features and then upcharge for those features in like a higher tier, and they'll have some sort of take rate on those as well.
It becomes monetizing agents at that point, or monetizing features. Absolutely. But just on the regular way that the business is structured now, that would be the way that they would have to combat it. It's going to be difficult for these companies, but my view is corporate America cannot get rid of certain platforms. Otherwise, things are not getting done.
Yeah,
that
but
have to be the bedrock of the companies.
We just had a 46-minute discussion about SaaS, and I think, you could make an argument, you could steel man both sides of the argument. And so even if SaaS in fact is not dead, because my agents for Workday will offset your agents to displace Workday, whatever, the fact that we can have a 45-minute conversation about it, which can go either way, shows the level of uncertainty that it's in the market, and the market's forward looking. So obviously the market's going to sell off on the uncertainty, let it play out, let the dust settle, and then see who's left to invest in. And you either pick up things for a bargain or you dodge a bullet.
You're right. And it's funny because I was talking, I think 2 or 3 days ago, to one of my buddies that works at one of the large investment firms. And he was saying that his call for this year is the boring companies are going to do well. Tech is going to lag and tech will rebound next year. And he's looking at the big financial institutions where they have over 100,000 employees. They utilize AI to automate the top 5 repeatable processes and do large rifts and expand margins that way. And he thinks that story is going to play out through the second half of this year.
Yeah, I wouldn't be shocked if I hope it doesn't happen, but that we see that big rebound after the midterms and tech and growth specifically. This, by the way, is from an article that went fairly viral, 2.7 million views. This guy specifically has been in the software and the SaaS industry for a long time. And it's an article that's worth reading. It's well nuanced, but basically he said, not all SaaS is created equal, that some is being disrupted, some is actually a lot stronger, and yet it's all being sold off. And so specifically, he isolated that, of course, if something has public data access and it's just a wrapper for that, even business logic, learn interfaces, talent scarcity, and bundling, those are not secure moats, and they're actually weaker, if not destroyed in some cases. And proprietary data has become actually more valuable, of course, with LLMs, regulatory lock-in, network effects, transaction embedding, and system of record was kind of mixed what he shared, but it's worth reading. You guys can look it up on X. But are there, like for myself, like I get asked several times a week of like, what software names am I interested in picking up? And there's some that I'm like, they're probably good. Like Wix, I'm interested in. ServiceNow, I think would be good, possibly, and Figma. Beyond like adding more Palantir, which I added a little bit more this week. But for the most part, like I'm just like, okay, let's let the dust settle a little bit. Silly can get sillier. Although Cloudflare is down 8% today because of the whole Anthropic cybersecurity stuff. So if I had to pick one, like if that keeps falling down, I may just at some point be forced to pull a trigger and create another position. So.
Now, I tried catching the bomb on ServiceNow, so we'll see what happens. I'll let you know how that works out.
Yeah, that was interesting. They announced announced buybacks. They said we're halting, or I think across the board they're halting planned sales voluntarily. McDermott signaled that he's going to be buying shares on a certain date. I guess you can remind us of what that date is.
Yeah, 2 billion worth of shares immediately, and they're doing 5 billion worth of buybacks over the next 2 years.
And I didn't look at it today, but stock went up a little bit. Microsoft, of course, had a big insider buy. It's actually down this week. Just barely.
Yeah, ServiceNow went down today. I mean, it's a 104. It's who knows what's going to happen. I mean, I'm probably going to have to throw a stop loss. I hate throwing stop losses out there, but I'm probably going to have to throw a stop loss of 95 out there, because if this breaks through 95, this could go to 75, and I'm not looking to take that ride.
Yeah, no, it can definitely collapse more. Still trading at, like, if you just look at its PE right now, it's elevated. A lot of these names, even like in cybersecurity, they're elevated too. So I'm like really curious if we have time for one last topic here before we pivot to after hours. SoFi. So in that interview,
we should talk about SoFi.
Yeah. So in that interview, like there's a few things we can discuss. Well, in the interview that Tevis and Tanner had with Noto, they asked him very directly on insider buys and stock valuation. Noto gave a very direct answer. And it sounds like that there's decent chance that he might be a buyer here. There are some things that could prevent him from doing that, the material non-public information. We've seen Microsoft with a large insider buy. There's been a couple of small buys with SoFi relatively to what we've seen in the past. ServiceNow, the market really didn't care, but SoFi is in a different space. It's not SaaS. Do you think a large insider buy by Noto would change the momentum of the stock, or would it just be a speed bump on the way down? Tevis?
I think if we accept the premise that a large insider buy changes the momentum of the stock, what I'm hearing in the background is that retail drives the stock. And I would challenge that. I would say the big selling is institutional, rotating, whatnot. I think the bigger catalyst is S&P inclusion, because S&P inclusion in my mind is really the end of, or the start of the end of the manipulation of SoFi stock, because of all that passive buying that happens from the ETFs. So yes, it would be good for sentiment. Yes, I'm sure it would fire up retail. But what I'm saying is I'm not sure the extent to which retail drives SoFi to 30 and beyond, right? I think that we sort of oscillate here. If the macro is more favorable to higher beta names, we settle around the 25 range over the next few months, let's say. And the moment at which we get into the S&P 500, probably June, at that point we start moving higher.
All right, would love it. Steve, what do you think? Big insider buy by Noto, does it change the trajectory?
Noto could drop 10, 20, 30 million. It's not going to change the trajectory. It's going to be, look, SoFi is just not one of those companies that's followed by the masses. It's a cult stock. It'll fire up at all of us. It'll follow up everybody that talks about SoFi on FinTwit. It's not going to fire up the markets. Tevis is right. The thing that SoFi needs right now is S&P 500 inclusion. That's going to be the biggest catalyst. It's going to give it legitimacy. It's going to give it inflows every 2 weeks. It's going to change the narrative around, can they compete with the large banks? Because I still think there's that narrative if they can compete. And when they get the accreditation from the S&P 500 that they are part of financials of the largest companies, I think that changes the narrative a little bit. It's the most important thing this year, besides rate cuts.
Yeah, that especially because it's a more heavily owned retail stock. I think that we will see a bump there. It is in a lot of the smaller indices, so maybe not as big as some people are hoping. But the challenge is right now the market cap is getting relatively close. We're at, I just looked it up, 24.13 billion for SoFi specifically. The minimum needed to get in the S&P 500 is 22.7. Now, the good news is we saw basically a year ago that the S&P 500 inducted a bunch of companies that were just barely above the market cap requirements. So it doesn't have to be by much. It just has to be eligible. Do you think SoFi remains eligible when they announce inclusions?
So I thought market cap was 18 billion. Hold on.
They've continued to increase it. They've increased it at least twice in the last few years.
They increased it?
Or something. Yeah. Look, now you get into a more interesting question, I think, Roy, because I think that what Noto's purchase could do is it could keep them hanging on for dear life on that market cap requirement. Because I think if SoFi falls below 1750, something in the between $18 and $17, then they would lose that inclusion status. And we're sort of at that edge. Let's say next week or next 2 weeks, whatever, Noto comes out with a buy. I think that'll bump us up to maybe 2050, 21, something like that. And I think we'll be good to go so that we don't dip below the requirement.
The problem is we can't live and die with Noto putting up his personal money. That should not be how this stock trades.
No.
Oh yeah, and
one of the big problems is that the tangible book value is $6.68. This is being looked at as a financial institution. This is being looked at as a bank. This is not being looked at as a tech company. And the reality is it's still trading at roughly 2.5 times tangible book, 2.5 to 3x. That is very rich for a bank or a financial institution. And that's how it's being viewed.
Yeah, it's been, in my mind, it shifted over to at least a fintech, if not a tech. We saw the valuation expand, the multiple expand rather, even into a couple of really, really good earnings. And of course, banks did really well over the last 3 weeks for the most part. There's some exceptions, and recently not quite as well. And SoFi was, no longer seen as a pure bank, but kind of the wrong timing for that. So,
but the fintech is not a sector of the S&P.
Yeah, I mean, it is a sector, but it's not.
It's not a sector. Financials is a sector. There's no fintech.
It is a sector still.
Not a sector.
Not in the S&P 500 specifically. They have broader categories, but it is at least a subcategory.
It's not a sector in the S&P, so therefore it does not matter. This is being looked at as a bank. And that's the problem. It's being valued as a bank. That's why it's coming down.
So it has 2 weeks. It's March 6th is the date of the inclusion. And of course, the S&P 500 might just do what they did one time last year and say, we're fine. We'll keep it all exactly the same. And there is a little bit less chaff, I think, than there has been in the past. But with SoFi as well, there's one other piece of news that maybe we want to save it for the after hours, or maybe just touch on it briefly, like the Blue Owl. I'm kind of curious. Blue Owl, of course, was a partner for SoFi with a loan platform business. I don't think that there's any material risk or anything at all for SoFi, just because that's a great thing about their loan platform business. It's asset light. There's no capital risk there at all. But Blue Owl might actually be purchasing less, although it is in a very different lending category. Do you think that is a hangover on SoFi as well, or is that not the reason?
This close to buying Blue Owl today.
Oh yeah,
this close. I've owned Blue Owl Corporation BDC, OBDC, for a long time. And I came this close to buying Blue Owl because it was yielding around 7%. I think it's trading for like 11.50 or something like that. And I didn't. But one of the big reasons why Blue Owl is down is, one, people are worried about data centers. I had that big deal with Meta. The other reason is there's a whole narrative going around. So Blue Owl is private equity. They invest in a lot of smaller companies, small to middle market, and investing in AI data centers, such as the Meta one that they're doing, is actually potentially cannibalizing the smaller companies that they're invested in. And the whole mark to market, they may have to, if they were forced to liquidate, they would probably have to sell at a much lower price point than what they may be worth or what they have them marked at on the books. That's why Blue Owl is getting into a very weird situation now. And I don't think it matters for SoFi. I think the deal they have with SoFi is not going to change. Blue Owl has problems that have nothing to do with SoFi.
Yeah, it's at the very least, it's very minimal what would impact them. Shall we call it an episode and pivot over to our after hours?
Real quick with SoFi, two things. One, do we think Noto is going to hit the 35 tranche of PSUs?
No, they're gone.
Because we still got, what, a month for him to get the price up to get there?
Yeah.
I 35 in a month? Come on now.
I mean, two, with how bad the chart looks, where do we think the bleeding stops? And are we wishing Goldman would just buy them or somebody would just acquire them at this point?
I don't really want to see them acquired. I think that they will. I want to see where they go as a company. I think that they're a very, very good business. And right now, unless it's just a blow us out of the way type of offer for SoFi, which I don't think they'd be getting right now in the current environment, I would just rather not see that. But where the bleeding stops, I don't think we see single digits again. Things would have to get really, really bad in the macro. We're talking about major recession, and I just don't see it. There's some cracks. There's been some cracks for a long time, but yeah, I think that we're.
Said that.
I mean, the question is, where's the next level of resistance at this point, or support, whatever you want to call it? What's the next level? Because we haven't seen this since July, these prices. We just went under 20, and it doesn't look like it's stabilizing at this point when I look at the chart.
Yeah. You got smaller levels around 18, and then you got a big support level in the at 16. So okay. I'd bet you money that we're not dropping below 16.
Yeah,
that would be nice.
So single digits. I'd put at single digit percentages that we drop in single digits.
I will tell you right now, if for some reason this goes to $9.50, I am buying so much SoFi.
I'll go all in.
I would consider exiting NVIDIA at that point.
Yeah. Dude, I would have exited NVIDIA at 16.
Yeah, that's not happening. But
dude, Amazon, Meta, NVIDIA, they're just flat, man. And it's just they're piggy bank positions, Steve.
I like my piggy bank, Tavis.
You got to break it sometimes, baby. You got to live too.
I don't have any hammers near me. Okay, so
you've never been a kid. You didn't want to, buy something. You're like, this bitch is getting broken.
Yeah, but I have a very good feeling about NVIDIA right now. The market is penalizing SoFi. I'm actually surprised it broke below 25. And look, the fact that it broke below 25, which was a very big support level, it is free falling. And I'm just wondering where that stops. And I can't figure out where it stops. It looks like you said, 15, 16. 15 looks like a incredibly strong, it's not going past that, but I don't know. This is very annoying at the moment.
Yeah, and the tough thing is, again, if SoFi was the only thing that sold off, way too much and irrationally, well, yeah, I think a lot of people would be buying it up. But the thing is, there's a lot of stocks that are in that same bucket, and it's hard. You only have so much money. Tevis, despite being a billionaire, he's out. I'm basically out. Steve, do you have a cash position, Steve, or is it mostly deployed?
No, I always have a cash position.
Okay, yeah.
I'm never 100% invested, and if I need to move money in, I can. And I also have cash in my brokerage account. SoFi is not at the point where it's a no-brainer, only because I am unsure of if this is the floor. If we had a different looking chart, I would probably be buying here. But I'm just unsure if 18 is the floor, if 16 is the floor, or if it goes lower. I need to see a couple of weeks of sideways to say, okay, I think this is going back to the 25, 30 range. And I think that's a good ROI for me to add capital at this point.
Yeah, absolutely. All right. Well, let's go ahead and conclude the episode. We're going to have our after hours for members only. If you're a member of any of our 3 channels, it's going to be live in about 5 or 6 minutes usually. It'll be a little bit shorter episode tonight, but we will see you guys on the other side soon. For everybody else, thank you for sticking with us. Hope you have a great weekend. Take some time to enjoy. And have a
All
good
right,
night.
everyone. If you are a member of Roy Tevis's or my channel, I just set up the stream. So we will be live in about 5 minutes on the after hours. Appreciate everybody being here. Have a great weekend. We'll see you in the after hours or next week.